If you've saved in a traditional IRA or 401k, you'll eventually have to take required minimum distributions, or RMDs. These withdrawals are mandatory once you reach a certain age, and they're taxed as ordinary income. But with the right planning, you may be able to reduce how much you owe, or avoid taxes on RMDs altogether. RMDs apply to tax-deferred retirement accounts like traditional IRAs, 401ks, and 403bs. The IRS sets the minimum amount you must withdraw each year based on your age and account balance. Starting ages vary. Age 73 if born between 1951 to 1959. Age 75 if born in 1960 or later. Failing to take RMDs can result in a 25% penalty, though it may be reduced to 10% if corrected. Roth IRAs are not subject to RMDs, and withdrawals are tax-free in retirement. You can move money from a traditional account into a Roth through a Roth conversion. You'll owe taxes on the converted amount now, but you may save more in the long run if your tax rate is lower today. If you're still working and contributing to a workplace plan, like a 401k, you may be able to delay RMDs from that account, as long as you don't own more than 5% of the company. This only applies to your current employer's plan, not to old 401ks or IRAs. A qualified longevity annuity contract, QLAC, lets you defer RMDs on part of your retirement savings until as late as age 85. You can invest up to $210,000 in a QLAC, and that amount won't count toward your RMD calculations until payouts begin. If your spouse is more than 10 years younger and is your sole beneficiary, the IRS lets you use a different life expectancy table to calculate smaller RMDs. This won't apply to everyone, but it can reduce how much you're required to withdraw and be taxed on each year. With a qualified charitable distribution, QCD, you can give up to $108,000 annually from your IRA directly to a charity and exclude that amount from your taxable income. You must be at least 70 and a half, and the donation must go directly to the charity by December 31st account. You can delay your first RMD until April 1st of the year after you reach the required age. But that means you'll take 2 RMDs that year, which could raise your tax bill. In some cases, taking your first RMD in the year you're eligible could be the smarter tax move. RMDs are a required part of retirement planning, but that doesn't mean you have to accept a high tax bill. With strategies like Roth conversions, QCDs, or delaying withdrawals with a QLAC, you may be able to reduce or avoid taxes legally. Consider speaking with a financial advisor to see what works best for your goals.